Welcome to Stocks in Translation. I am Jared Blickery, your host, and here next to me is Sydney Freed, aka the voice of the people. And before we get started, be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming back Todd Sohn. He is an ETF strategist at Strategas Asset Management. Hello, Todd. And today we're going to be talking about some of the record risk flows we've seen into various ETFs and ETF classes this year. Our phrase of the day is market cap. It's how stocks get valued and indices get weighed, kind of. And there is an asterisk there. And this episode is brought to you by the number 3,500. That's the number of ETFs now available to US investors, why even more are on the way. And Todd, we last talked to you in July. A few things have happened since then. What do you make of the markets right now?
Well, the market loved that the election passed with certainty, right? And there's always uncertainty out there. We never know what's going to happen in the future, but at least we had a result in the night of, rather than dragging this out into 2025. Sure. Now, with that clearance, we have seen a massive amount of money go into equity ETFs, roughly $240 billion or so over the last 3 months. That is the highest on record. Now, part of this is the adoption of ETFs, and part of it is also everyone just jumping into the pool. And so I always look at ETFs as this great lens into investor psychology. Everyone is now feeling great about the market, and they should. The market is risk on. Things are in very good shape for earnings and the economy and whatnot. But in the short term, it does make for a little bit of too much optimism in my sense, right? Maybe people are getting too aggressive. You're seeing volume into leverage products, right? Especially 2x leverage single stock ETFs, which is a little bit of an oxymoron. But it makes me think that, okay, when we get too optimistic, that can set you up for a little bit of a speed bump.
All right, we're going to pause there for a second. We want to get into our phrase of the day because this kind of ties into some of the metrics we're going to be talking about here, and it is market cap, or otherwise market capitalization. It is a total value of a company's outstanding stock calculated by multiplying the current share price by the total number of shares. So you take the share price, if there's 1 million shares, you multiply that by 1 million. It's that simple. So we use market cap in a number of ways, and I just also want to first disclose it's different from the way the S&P 500 and the NASDAQ are calculated because they use float cap. And float cap is something that uses the number of restricted shares. They count them out so that they don't unduly influence the index. So they're actually taking the total shares and taking some out. But whether market cap or float cap, that's how we get these huge rises in value in the S&P 500 and the NASDAQ 100. How do you think about these things?
We live in a market cap weighted world, and the markets is a voting mechanism, right? We are voting by making these companies larger, that they're the best companies around, they're the best equity investments. The one thing about market cap weighting, though, is it can skew a lot of what happens internally. Think about a car, right? The outside of a car is necessarily the market cap. It looks fine. But if you bring it to the dealer or your auto service company,
tires?
Yeah, you got to look under the hood to see what's going on with the rest of the market. And as long as the rest of the market, aka the engine, the oil, all that stuff, is fine, then we're in good shape. And so right now we are in pretty good shape. You're seeing all these smaller parts of the market, whether it's industrials, financials, discretionary, still participate outside of those big market cap names that are held within largely the technology sector.
So you're saying it would be dangerous if one company was like trillion dollar market cap and none of the other ones were even close.
Yeah, or if none of the other names were rising with that mega cap name, that's a big problem because it tells you the market's on very thin stilts.
And yet we saw that earlier in this rally in different phases in the bull market rally, but it seems like the rally is just kind of fine right now. Even small caps are finally catching up. So what do you think is going on there? Were our fears unfounded?
I think with small caps, it has been a very challenging market, right?
So it's been 3 years.
We are on perhaps pace for the Russell 2000 to make its first new high in 3 years. Yeah. That is the third longest streak in history. And you think about the constituency of small caps, it's a lot of banks, which are now perhaps benefiting from a deregulation effect. And it's a lot of small cap biotech names, which are having a little bit of a struggle here, depending on what happens with the administration. But I think a lot of investors are saying small caps are attractive on a valuation basis, and they haven't worked in so long that they're just they're just going for it. They're moving away from mega cap growth and into these.
That
other
doesn't
areas.
sound like the best investment thesis, though. Like it's been a while, so we're going to give you guys a chance. Here's all my money. Like,
Yeah.
how do you protect yourself there?
Well, you want to make sure when you buy small caps that you know what's in the index itself, because the Russell 2000, some 40 to 50% of it is unprofitable. These companies do not make
Zombie
money.
companies.
Zombie companies. And so I like the idea, if you're to play small cap, use a different index provider. Like the S&P 600 at least has a filter for profitability. So you're going to get higher quality companies in there. Or you could use an active manager who studies small cap stocks for a living, and if they do their job correctly, they will find those winning stocks and the investment will perform well.
Is it worth the risk though? Like, why don't I just put all my money in mega cap stocks that don't seem to stop ever?
It's a great question, and it's about diversification, right? So if I'm buying the S&P 500, I'm getting a lot of technology exposure and a lot of growth exposure. With small caps, I'm balancing it out a little bit. And I'm not going to have, the most of my portfolio is going to be in large cap stocks, right? But there will be times where those take a breather, and you'll see the more value-oriented corners, such as banks, which are very dominant in small caps, assume a leadership role. And so that can balance out the volatility of your overall portfolio.
So you said stock ETFs took in $240 billion in the last 3 months.
Record.
What are you seeing for 2025?
More records broken. We are seeing record launches for ETFs, right? All sorts of providers, whether they are offering new derivative type strategies or legacy mutual fund providers now coming into the space. And as an effect of that, we're going to continue to see money pour into ETFs. Now the difference will be, what is the pace of that? Is it just a slow billion or two every day, which is okay? Or is it going to be more like $5 billion today, which is what we're seeing now, where there's just a rush to add exposure. So a lot of it's going to be market dependent. Year 3 of a bull market, which we are in right now, can be
we can talk about that
a little
too.
tricky. They can get a little bit of a speed bump historically. So maybe that resets flows, but I expect that we'll continue to see more and more adoption.
Yeah, I've been thinking a lot about that year 3 thing. And so here's a premise for the audience that in year 3, well, in years 1 and 2, you tend to see this big animal spirits rise, and then 3, things cool down. Now, the average returns are still positive, but not 1 and 2 positive.
Right.
But this was an unusual bull market, just in terms of what we've seen in the last 40 or 50 years, because we didn't see small caps participate in the beginning the way we usually have. And I think that has to do with the Fed and hiking interest rates the most in 40 years. There's a lot going on. But what do you think happens from here forward?
I would at least rein in expectations that we continue on this linear path forward like we have for the last 2 or so years. It does not derail the bull market.
So not double-digit growth, the next year?
It's not out of question, but at least, if you're looking for another 30%, that may be a little bit high hurdle. It does not mean you should sell everything. You should stay invested for sure. But as a cycle progresses and more variables come into play, right, the pace and level of interest rates, it can be a little bit more of a pause year, right? Maybe we're flat for all we know. And there will be winners and losers at the sector level too.
Mm-hmm.
There should be wide dispersion. But I am just saying maybe buckle our seatbelts here for a little bit larger of a correction. The largest correction we had in 2024 was about 8%. 2023 was about 10%. Maybe we get 15 to 16 next year for all we know.
So is there something investors should be doing right now? Should they be getting into a specific area that might
Hedging
be
a little
better,
bit?
hedging?
Yeah, I think depending on your time horizon and your risk, it cannot hurt to have some sort of plan to say, maybe I should, if you can buy put options, or you can review your current holdings and say, I have too much mega cap growth, maybe I should sell some of that and put it into small cap or even international stocks if you're looking for more diversification. But just have a plan of when that correction strikes, or even if you're in a lot of cash, there's $7 trillion in money market funds, maybe you say, okay, if and when there is a pullback, I'm going to take the cash that I had in my money market funds and buy the S&P 500 or small cap 600. Have that plan in place.
You and I just saw each other at a CMT event. That's Chartered Market Technicians, and that's where all the technical analysis people get together. Sid, you're laughing.
It sounds like
Care
a
to say
riot.
something
No,
here?
I'm
Okay.
just saying it sounds like a good time.
Yes, it
It's a
is.
cult.
We had a great time. But there was a lot of bullishness, not only over the short term, and actually over the short term there's some mixed opinions, but over the longer term, into the end of the decade. People were talking and making comparisons with not only the 1990s, the late 90s, where we saw those double-digit returns for maybe 4 years in a row, but also the 1920s. And I don't know that period quite as well. I don't have the best data from that era.
Yeah.
But what do you think about this this thought that we're just going to sail into the end of the decade because of AI?
I agree with you on the thoughts that are quite provocative. That was probably the word for me.
You're going to couch this, yes.
So if you think about the last few years, we had a bear market in 2022. We had a very short but deep bear market in 2020. And there was also a bear market in 2018. So that's 3 over the last 6 years, basically. That's very frequent for deep 20% drawdowns. And so I like the idea then, outside of the typical 10 to 15% correction, that we can continue to run higher into the end of the decade. AI seems to be the catalyst because of the power it'll give for productivity. But having another decade-long run is not out of the question. We saw it in the 90s, and we saw it back in the 20s. Ultimately, those turned into bubbles, and the bubbles pop.
Yes. I mean, 1930 and 2001 were not the best years for stocks.
Yeah. So ultimately, things get a little too out of hand. Everyone gets complacent, right? And things start getting a little wacky. But it seems like we're far off from that for now.
Is there an under the radar play that you think could come about that's kind of on par with AI or could catch up to AI?
I wonder if it's a derivative of AI. I mean, and that idea, I don't know if it's under the radar, but it's electrical and nuclear power. It's like, how do we get AI? And the typical computing power doesn't seem to be cutting it. And now there is talk of building modular reactors, nuclear reactors and whatnot. And there are stocks that are benefiting from that. They are volatile stocks right now, but that seems to be one of the plays. And maybe at the sector level, I wonder if some of the more industrial type companies could benefit from AI. Industrials have been great. Machinery stocks in particular have done really well. And so I wonder if they'll benefit somehow than us sitting at a computer typing into ChatGPT.
Yeah, it sounds like though AI is kind of the driver's seat here. All right. We need to take a short break, but coming up, we are sizing up the ETF universe. And on today's Who Wore It Better, we are popping the cork on asset bubbles. Stay tuned. And we are back. This episode brought to you by the number 3,500. That's the number of ETFs available to U.S. investors. Just when you thought there was an ETF for every occasion, for every style, even for every risk preference, when considering leverage ETFs, there are more ETFs on the way, as always. Todd, tell us about this. 3,500 ETFs, that's about the number of stocks on the New York Stock Exchange or on the NASDAQ.
There's almost an ETF for everything at this point. You can find the solution you'd want. Some of them will be long-term holdings for your portfolio for retirement. Some of them will be, you have a few extra bucks that you'd like to throw around. And I think the challenging part for the industry is to think up new solutions that actually fit somewhere within a portfolio. Why should I buy this ETF? And I think the latest kind of craze is using leverage on single stocks.
So there's ETFs on, multiple ETFs on Tesla, for instance.
Yes.
Long, 2 times long, short, 2 times short, et cetera.
What is a leveraged ETF?
It will produce, ideally, now these are complicated products. These are not for everybody, right? But the idea is they produce 2x the return on a daily basis. So if Tesla, so they'll use swap, what is called a swap.
Derivatives.
Yeah, derivatives. So if Tesla goes up 2% one day, if you hold the 2x long Tesla ETF, it'll go up 4%. It can be very seductive, but the math is complicated and is very volatile.
The other thing is, so if you hold one of these 2x ETFs and Tesla moves 10%, if it moves 10% up on a very volatile basis going up and down, you could lose money in the 2 times ETF because it's rebalanced on a daily basis.
Exactly. And so now, we're talking about solutions, there are issuers out there who are providing leverage ETFs that they reset monthly. Right, so if the S&P or Tesla returned an X amount on for the month, you'll get double that for the month.
And then we'll have bespoke reference dates or whatever.
Yeah.
All right. So when does it end? Like where?
Gosh,
it doesn't.
I don't know if it does. Maybe somewhere along the way something breaks for whatever things happen in the market. There's variables.
Volmageddon in 2018.
That was an
kind
example,
of
right? That reset some of the expectations, especially around volatility-based products. Perhaps something like that happens. So be careful out there, and maybe that then brings about some sort of regulation. Who knows? To rein back in what's happening with all the leveraged output that's out there.
How does an ETF even get created? What's the process? Who decides?
So there are issuers out there, and you and I can start an issue if we wanted to. We draw up a plan.
Sid's
I'm
ETF.
ready.
Yes.
He's
I'm
ready
ready.
to be an ETF manager.
Ticker SYD.
Yes.
We would then have to make a prospectus. You get a administrator and you basically submit it to the SEC. They approve it. You seed it with some money, right? Depending on how much money you want. It can be 250,000. It can be 2.5 million. It can be 200 million. And if you check a few boxes, get some connections set up, and all of a sudden you're on the stock exchange. And there are providers out there. They're called white label providers, right? It's the same thing in the music industry.
You're going to need that, Sid.
Okay.
I just checked.
Yeah.
The SYD ticker appears to be
taken?
available.
Oh,
No,
Perfect.
so it's only taken in Australia, which is the Sydney Airport Limited company,
Let's-
which publicly traded over in
Let's
Australia.
trademark that.
All right.
Yeah.
This is a big part of the industry, though. These white label providers who will do everything for you. You just need the idea. Same thing as going into a recording studio, and they'll produce it for you and release it.
When a stock like Nvidia gained a lot of steam, all of a sudden were people just like, well, we have to get this stock into an ETF.
Yep.
Into the leverage ones.
Into a, yeah.
Oh yeah. So there's a 2x leverage Nvidia ETF. It has about $6 billion in assets. That is massive for
A leverage, yeah.
a leverage ETF and just an ETF in general. So that just shows you how popular. Part of that is because Nvidia has been on such a great run in performance,
Right.
but it is collecting assets.
Is there are ETFs something that you could that could be your only investment your whole life and you'd be okay?
Oh, absolutely.
Because you
They're-
can track the S&P 500.
Yeah, and they're very tax efficient. They're very low cost, and so they are meant for long-term investing.
So the dangers we were talking about with leverage don't apply to something where you're just tracking plain vanilla S&P 500 with no leverage. What about smart beta? So there are these ETFs that try to track hedge fund strategies. Some of them work well. A lot of them haven't.
Yeah.
What do you think about smart beta?
I think it can be interesting for a sleeve of your portfolio.
Sleevier.
Yes, not the dominant weight,
Okay.
right? 10% or so, if you wanted to differentiate from equities. And it depends on the strategy. There's so many smart beta or hedge fund type strategies now available. They all do different things. Some of them are trend following strategies for managed futures. They'll buy coffee, they'll buy soybeans or something like that. Really out there. Some of them may buy stocks with the highest momentum. Right, speaking of smart beta, and that's a differentiated strategy if you don't believe in market cap weighting. But I think the end result is basically saying we don't want, as going back to the market cap discussion, we don't want to weight by market cap. We want to weight stocks by something else, or we want a completely different asset class like managed futures or currencies and commodities or something like that. It's really just all about differentiating what you currently own.
What's your biggest piece of advice for someone who's just deciding
Brand
what
new.
ETF?
And how do you search for it?
Oh, Yahoo Finance.
Thank you.
One.
That's the right answer.
And I would go very simple and vanilla. Large cap ETF from many providers out there. It would be very low cost. Some of them are as low as 2 basis points. That's going to basically free. Stick with that and let that grow over time. Put money in an account every month or so. So that way you're just constantly adding to your investment. And then over time, you can start to diversify out once your account gets big enough.
All right. With animal spirits running high these days, guess what? Crypto knocking on 100,000, Russell 2000 making record highs. It's time to focus on bubbles. Not that we're necessarily in one, I should say. But we're going to start with a non-traditional market first. Sports franchises, the untouchable darlings of the asset world, from billion-dollar bids for basketball teams to sky-high price tags on soccer clubs. These investments just don't seem to lose their luster. But here's a twist. Are these stratospheric valuations a sign of enduring demand by the loyal fans? Or are we watching yet another bubble quietly inflate? And contrast this to traditional finance markets, where euphoria from stocks to crypto has taught us that time and time again, what goes up too often crashes back to earth. So Todd, who's wearing it better then, the iconic and enduring allure of sports franchises or the high-flying speculative drama of financial markets?
I mean, I tend to go with the sport franchises, to be honest with you. It's one of
Personally biased?
Yeah, a little bit. I always find it amazing that sport franchises, when you see a new team go up for sale, and it's spreading beyond just, say, basketball and football. You're now getting soccer, women's soccer, which is great, the WNBA. The asset values just don't go down, right? And it doesn't matter what the economic cycle is, what the interest rate cycle is. And so this is a great example of just supply and demand in the economic world. There is a very finite supply of sport franchises, whereas there's not much of a finite supply for ETFs or stocks these days. And so when there's one available, everyone springs on it and basically drives up the price.
Need a 2-time levered ETF on Chelsea or something.
I was going to say, when do all the sports teams go public so I can invest in an ETF?
There's been attempts to do sport derivatives, right? There were ETFs that looked at companies that sponsored sports stadiums, right? There were companies involved in sport. There are ETFs for sports betting.
And you got Madison Square Garden.
Yeah, Madison Square Garden, Formula One. And there's a couple of soccer teams that are public overseas. But there's a very nascent effort to get private assets into an ETF. And that's a very complicated subject.
Well, if you want to
regulatory
sell to the public, I would think so.
Yeah, and so I just wonder how long before we are trying to put slices of a sport franchise. There's a lot of regulatory hurdles to this, but slices of the teams into the ETF.
We did it with crypto. I do it with sports.
Anything is possible, but I think it feels like a matter of time before that happens.
I do want to ask about crypto. How are you seeing the crypto ETF market right now?
It's booming. One of the greatest examples. Yeah, exactly. It is rare for a new asset class to come into the public domain, right? Equity ETFs 30 years ago, fixed income ETFs 20 years ago, commodity ETFs 15 years ago, and crypto, which I think some folks were skeptical of, they didn't know how it worked, how to buy it, is now in the safe wrapper of the ETF, has the whole financial system backing it, comes available, and it's exploding in terms of demand. The flows have been great. The trading
and the industry almost died 2 years ago, by the way.
Oh, so yeah, and this is crypto's volatile.
The comeback is just amazing,
right? If you buy Bitcoin, Ethereum, whatever the coin, the market is, expect volatility. That's at least been the historical precedent over the last 15 years. You can add a little slice of it to your portfolio, but this is all about access. That's what ETFs are here for: access to new markets. And so, issuers are coming out with all sorts of products. You're going to get you have spot crypto ETFs. You're going to get buffered crypto ETFs. Covered call crypto ETFs, so the whole ecosystem is going to explode, and investors will show their demand for it.
You think next election we'll be able to buy an ETF that bets on the winner?
Oh gosh,
just thinking of new ideas. Here.
I mean, the one problem with that is it's a kind of a binary event in what happens. Though there are defined maturity fixed income ETFs, so they do close after their shelf life exists. So there's somewhat of a precedent.
Defined fixed maturity ETFs. There you go, Sid.
There we go. There we go. Anyway, how do you pick a crypto ETF? Does that differ from your advice for others?
They're all very similar. They track the spot price of Bitcoin or Ethereum pretty well. Their fees are in the same ballpark, right? Pretty low cost, 20 basis points or so. There's a couple maybe low to none. So it almost comes down to what's your brand preference. Do you have an issuer, or maybe you have a friend who works in an issuer who you're going to support them?
Brokerage account is,
or your brokerage account, right?
Fed into those.
Or if you are a large investor or trader, do you need the liquidity? Do you want the one that trades the most? For the most amount of people, most amount of traders, that's not going to matter.
So you've told us a few things that you love. You love Disney.
Oh yes.
You love running.
Oh yeah.
You love wellness.
Try to.
Do you think there's a spot in people's portfolios to invest in things that they love, or do you think that doesn't have a place in your finances?
I think if you feel strong about a cause, you should absolutely put a portion of your portfolio into something that you feel strongly about. Don't make it the dominant weight. And this goes for employees at companies who are getting more and more stock by their paycheck. You don't want to load the boat to one single item too much. But if you feel strongly about some sort of cause, maybe it's a healthcare company donating to some research or something like that, then absolutely, I think you should invest in it.
How do you invest in running? Just like
you can buy running shoes.
You can buy Berkshire Hathaway.
There we go.
Yeah.
Perfect.
But yeah, if you
talk about a concentrated investment, Warren Buffett is very concentrated in this stock.
If you feel like you are a fan of a pair of running shoes and you start to see more of your friends wearing that pair, that brand, you might be onto something there.
That's a sign to invest.
Yeah, exactly. Yeah.
There we go.
Put some money towards it.
It is time to wind things down here. Make sure to check out all our other episodes of Stocks in Translation on the Yahoo Finance site and mobile app. Also, we're on all the podcast platforms you know and love: YouTube, Apple, Amazon, Spotify, Podtail, etc. That is all for now. Keep it tuned to Yahoo Finance.